Ladies and gentlemen, good day and welcome to the Greaves Cotton's Q2 and H1 FY2025 earnings conference call. We have with us today Mr. Nagesh Baswanhalli, Non-Executive Vice Chairman, GCL, Ms. Akhila Balachandar, CFO, GCL, Dr. Arup Basu, Managing Director, GCL, Mr. K. Vijayakumar, ED and CEO, GEMPL, Mr. Narasimha Jayakumar, CEO, Greaves Retail, Mr. Chandrasekhar Tyagarajan, CFO, GEMPL, Mr. Atindra Basu, Group General Counsel and Company Secretary of the company. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. As a reminder, all participant lines will be in the listen-only mode, and anyone who wishes to ask a question may enter star and one on their touchtone phone. To remove yourself from the queue, please enter star and two. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nagesh Baswanhalli. Thank you, and over to you, sir.
Good morning, everyone. Thank you for joining the call today. Just from an overview, Greaves Cotton's journey over the last 5+ years continues as we accelerate from a traditional engine company to a fuel-agnostic mobility solutions provider, driven by a strong purpose of empowering lives across India. Our primary strategy of getting closer to the consumer, extracting life cycle value while going about in a fuel-agnostic and a sustainable manner is beginning to take shape. Multiple revenue streams have been created. Our B2C part of the business continues to grow and in fact be a significant portion of the quarterly revenue. Also, by integrating technology across the value chain, we're building an agile ecosystem that maximizes the synergies across the various businesses while adding value to the end consumer. So without any delay, let me hand over the discussion to the management to take you through the quarterly financials and the quarterly progress. First up will be Akhila Balachandar, the CFO of the company.
Thank you, Nagesh, and good morning, everyone. I'm pleased to report that the company delivered healthy financial results for the period under review, demonstrating the effectiveness of our strategic initiatives. During the quarter, we recorded consolidated revenue of 705 crores, while on a standalone basis, our revenue reached 468 crores. Excel recorded revenue of 61 crore to reach 124 crore in H1 with double-digit EBITDA margins. Our engineering and retail businesses each maintained growth quarter-on-a-quarter basis with 4% and 7% increases respectively for Q2 and 6% and 7% increase in H1, thus reflecting our strong market positioning. Our electric mobility division also delivered impressive results, generating 175 crores in Q2 and 302 crores in H1. This growth was supported by a focused approach on new product launches and a defined path toward profitability. When we look at the combined performance of GCL and Excel, the exceptional financial results reflect our strategic efforts to diversify the product portfolio over recent years. Following Excel's acquisition and integration, the consolidated revenue from GCL and Excel reached 528 crores in Q2 and 1036 crores for H1, giving us a firm foundation to provide a solid platform for future growth and innovation. Profitability metrics showed significant progress. On a standalone basis, EBITDA for the quarter was 59 crore, up by rupees 9 crore from last quarter and improved by 130 basis points. Combined GCL and Excel's Q2 EBITDA stood at 76 crore, with margins at a robust 14.4%. Standalone PBT for the quarter amounted to 56 crore in Q2. In H1, our consolidated revenue reached 1,345 crore with EBITDA of rupees 50 crore and PBT at 21 crore. Standalone revenue for Greaves Cotton was at an impressive 7% growth, amounting to 912 crores, while EBITDA amounted to 109 crore. Our strategic emphasis on margin improvement has been reinforced by efficient working capital management, helping us to maintain a strong return on capital of approximately 16% plus. We continue to sustain a nearly zero debt balance sheet with standalone cash reserve of 350 plus crores, positioning us well for future investments and expansions. Looking forward, we remain committed to growth and transformation, leveraging our solid foundation and dedication to excellence to seize the future opportunities. Despite external uncertainties, our internal focus on profitability and strategic execution continues to drive our success. We are confident that the strategies implemented over the past few years will yield sustained performance. Thank you. With this, I invite Dr. Arup Basu to share his remarks on the engineering business. Over to you, Dr. Arup.
Thank you, Akila, and good morning, ladies and gentlemen. I will talk about the engineering business, which comprises Greaves Engines and Excel. I am pleased to report that Greaves Engineering continues to perform well. In H1 FY25, diesel three-wheelers experienced strong volume growth. In gensets in the second quarter, we experienced a more subdued performance compared to the previous quarters. The CPCB 4+ norms became applicable in Q2 FY25, making diesel gensets more expensive, and large-scale purchases had occurred in the quarters prior to that. However, the underlying demand remains robust. As part of our commitment to sustainability, innovation, and conspicuous customer value, we have introduced an emission control kit which can be retrofitted to enable even older gensets comply with the latest emission norms. Excel, with its customer-first approach and efficient operations, continues to deliver industry-leading profitability, with exports constituting a significant proportion of revenues. In H1 FY25, while Excel's share of wallet with OEMs remained intact, sectoral demand growth, especially in agri, was muted due to a slowdown in infrastructure project execution, reduced mining activity, and lower fleet utilization due to heavy rains. With the anticipated increase in infrastructure spending, demand is expected to recover in H2. The agriculture industry too is showing signs of improvement. A diversified export product portfolio and geography is part of our strategic plan for sustainable, profitable growth while mitigating related risks. Exports accounted for over 10% of Greaves Engineering revenue, with motion control solutions from Excel contributing to about 65% and engines the balance. Looking ahead, we are well positioned for sustained growth. Our R&D continues to focus on ensuring compliance with the upcoming regulatory standards, which is an ongoing program, application engineering, expanding the range of fuel-agnostic IC engines and gensets, and building a new line of business in electric powertrain. For the next commentary, I now hand over to my colleague Narasimha Jaikumar. Thank you, and over to you, Narasimha.
Yeah, good morning, everyone. This is Narasimha Jaikumar, CEO of Greaves Retail. Quick overview. Greaves Retail continues to be amongst the leading players in the three-wheeler ICE part segment. We're also making significant strides in the electric three-wheeler or the e-rickshaw powertrain business, and we are capturing greater market share as we continue to expand our presence. In the e-rickshaw segment, we are already the market leader for parts which are made in India, and this business is growing strongly. We launched several new products targeting the e-rickshaw segment, covering now a full range of motors, controllers, DC-DC converters, and other vehicle parts like tires. Greaves Retail, now with a wide-ranging network of over 250 distributors, 10,000 plus retailers, and 25,000 mechanics, has built a strong ecosystem which fosters close connections and seamless experience for our customers. Our mechanic loyalty program app has now over 8,000 active scanning mechanics on a monthly basis. Our three-wheeler multi-brand parts now cover both CNG, and our two-wheeler parts also continue to grow well. On the services side, Greaves Care franchising operations continues to be the leader in multi-brand servicing for three-wheelers, and increasingly we are enabling the network to service electric three-wheelers and electric two-wheelers, and we have at the end of September more than 210 franchise outlets all over India. And today, most of the bookings, 70% of the bookings are done by the Greaves Care app, providing unmatched digital convenience to our vehicle owners. For the second half of the year, there will be greater focus leveraging Excel's manufacturing capabilities and development of new aftermarket part lines for the heavy commercial vehicles, the HCV, and the construction equipment segment, both of which are booming given the massive infrastructure push and the construction activities all over India. Across Greaves Retail, digitalization is playing a key role to drive greater supply chain efficiencies and to improve our overall customer experience. Thank you, and over to you, K. Vijay Kumar, CEO of Greaves Electric Mobility.
Thank you, Narasimha. Very good morning, ladies and gentlemen, and thank you for joining us today on our earnings call. This is Vijay Kumar, Executive Director and CEO of Greaves Electric Mobility. I'll briefly talk about the performance of GEM. We call Greaves Electric Mobility at GEM internally, post which we can commence the Q&A session. Greaves Electric Mobility reported a very healthy performance reflecting our commitment to growth and innovation last quarter. We continue to be a very key player in the e-two-wheeler and three-wheeler segments, focusing on affordable mobility solutions with the goal of making Har Gali electric. Our volumes saw a remarkable growth in Q2 FY25, surging by 30% in the three-wheeler segment and by 29% in the e-two-wheeler quarter-on-quarter. This surge can be attributed to our new product introductions and other product enhancements which have been well received in the market. I'm also happy to inform that we have been developing our financial retail partnerships, and we have signed up with multiple financing partners, including Shriram Finance, to enhance national-wide financing options for our L5 vehicles. While we are encouraged by our sales growth, our key thrust is on efficiently ramping up our presence and reach to further drive visibility and our volumes across the country. Our robust support network includes over 400 sales and service points for e-two-wheelers and more than 250 of three-wheelers, allowing us to deliver exceptional customer service. We are also conducting various customer care camps and training programs for mechanics to certify them as Ampere certified technicians. Our strategic focus always has been on optimizing our cost and growing sustainably. To enhance our pricing power, we are actively optimizing our bill of material cost across our entire product range and are actively engaging with suppliers across the spectrum on this. This has resulted in a 7 to 12% decrease in our BOM cost across different models in H1 FY25. This is also a testimony of our intent and ability to prudently manage our balance sheet while driving growth, build on the economies of scale and knowledge expertise of Greaves. We are also thrilled to announce that Akshar Patel, our favorite Cricket World Cup T20 champion, has joined as our brand advocate to promote Greaves Electric Mobility. Our electric three-wheeler, Greaves Ultra City, is registered in India Book of Records for the longest ride on a single charge by any EV three-wheeler in India, covering 225 kilometers on a single charge. Our management team is committed to regaining our Q4 FY23 performance through a focus on innovation, dealer expansion, and ramp up of our new after-sales initiative called Ampere Care. We continue to grow month on month and our volumes grew nearly or more than 70% over Q2 in the festival month of October, which is just concluded last month. And this growth has been across two-wheeler and three-wheeler, building on other new products and the new models which we have launched in H1. As we move forward, we are continuing to work on enhancing our existing models, introducing new variants across our entire product range. Our key differentiators include best-in-class LFP batteries, affordable pricing, and strategic financing options through Greaves Weekend. Together, these initiatives position GEM for sustained growth and success in the ever-evolving electric mobility space. Thank you, ladies and gentlemen. That concludes my opening remarks, and I would now request the moderator to commence the Q&A session, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Sharma from SP Capital. Please go ahead.
Yeah, hi, good morning, team. So first question I wanted to ask on the vision that we have been highlighted, which is a 15,000 crore revenue. So what synergies that you are, working on the same, and from where do you see the major contribution amongst all our 5 verticals? Will it be from the retail or XL or EV?
Thanks, Kunal. Let me take that. This is our board vision at a strategic level and the direction that the board has set for the company. If you see the 3 businesses that we have focused over the last few years in our transformation journey, we believe all the 3 are now at an inflection point and set to fire. So we expect all 3 to grow and contribute to our overall vision. And the idea is, as part of the transformation strategy, to diversify from our single product, single company dependence to a fuel agnostic, multi-fuel, multi-revenue stream, the diversified revenue stream company, which is therefore protected and resilient to any external market forces. Hope that answers the question.
So will you be able to give any percentage allocation if you could just share the ballpark number? Where you have mentioned the 3 verticals, that is right, but will it be from the higher chunk from retail or EV and engineering?
The focus is on diversifying from our original dependence on auto diesel engine rather, and how we diversify out of that is the strategic goal and transformation agenda. And therefore, there will be multiple contributors to this overall journey. And if you see what the board has set out for us, it is also a mix of inorganic and organic growth. So I'm sure that multiple levers will play into this. Thank you.
Okay. My second question to Mr. Jayakumar, on retail business, see, if we are growing at a mid-single digit, right? So, however, the category is so large, so can't be expecting the growth of in the range of double digit. And you see this category can become a 2 to 3 times going forward in the, let's say, 2 to 3 or 5 years, that whatever the vision that you have been given. And if yes, then what, when do you see this kind of growth?
Yeah, so thank you for the question. I think certainly the categories in which Greaves Retail operates, as you know, we span both from service sales to parts across different commercial vehicle asset types, ranging from 3-wheelers, electric 3-wheelers, to small commercial vehicles to all the way to HCVs and the CE segment that I talked about. I think certainly there is a massive headroom for growth. We are I think the business is set for that kind of a growth as well. I can't obviously speak for exact numbers, but the opportunity exists, and we are actually gearing up. We're making a number of improvements in our supply chain, sourcing, and a variety of areas to be able to set up the business for faster growth.
Okay. But when do you see, I just wanted to ask on that, what's your aspiration to be there?
No, I think we should be seeing faster growth in the coming quarter is what I can say.
Okay.
Yeah, because as you're aware, in the first half of the year, we also had the general elections and also very inclement weather, as one of my colleagues also commented. Certainly, we are looking at higher growth in the coming quarters.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We'll take the next question from the line of Zaki Nasser from Nasser Investments. Please go ahead.
Good morning, and I think I should congratulate the board on the broad, great outline for 2030. So my 2 questions are, sir, if you set out for 15,000 crores 4 years hence or 5 years hence, we should start seeing the growth immediately from this year onward, at least a small bit of growth. How do you plan this? And my second question is, sir, this requires a pretty large capital. So what is your thoughts on getting the capital for this? Thank you.
So thank you, sir, for the question, and I'll take both your questions in order. The first one, as I said, this is the vision that the board has set out, and yes, over the last few years, we have been on this transformation agenda, and we have put in place all the levers for the growth in terms of both revenue, cost management, working capital management, and also on the capital efficiencies itself. So I'm sure all the levers are in place, and with the guidance of the board, and we will be able to the aspirations that we've set out for ourselves. The second question on the availability of capital, I would like to put 2 points here. One, we are highly efficient in our working capital management, and that is something we are constantly working on. 2, as you can see, we have currently approximately 350 crores of cash available on the books, which will strengthen our focus to be able to invest in organic and inorganic growth, both internal capex as well as inorganic growth. Do we need more capital? As and when the need requires, the board is very cognizant and will take whatever required measures are to be done to ensure that the growth opportunities of the companies are not starved, and we will not starve for capital, and the requisite initiatives will be taken on that front. Thank you.
Thank you. Thank you, and best wishes.
Thank you. We'll take the next question from the line of Sonal Minhas from Prescient Capital Investment Advisors LLP. Please go ahead.
Hi, this is Sonal Minhas. Am I audible?
Yes, sir. Please proceed.
Yeah. Ma'am, my question is with regard to Greaves Retail. I wanted to understand the reason for a dip in the EBITDA margin of Greaves Retail for this quarter when we compare to Q2 last financial year. If you could just give some subjective commentary around that, that will be helpful.
Sure.
Thank you.
Sure, Sonal. Thanks for the question. So, Sonal, if you heard Mr. Narasimha, our CEO for the business, Greaves Retail is a business. We are having a lot of opportunities for growth. It's a high margin business, and what we have done over this year is done investments in technology, people, resources, some amount of brand building at the grassroots level. All these are investments which will help us grow the business over the next few years. And that is the reason why there is a dip in the EBITDA margins. Otherwise, the business continues to be robust, and at operating margins that also we focus on internally, we continue to ensure that the margins are in line with what we are building for.
Okay, so over time this should basically go up because there are additional investments in the business. Basically.
That's correct.
Got it.
Yes, that's correct.
My second question is somewhat linked to the vision, ma'am, basically, and I'm sure there are some guidelines on profitability, return on capital that the group and the leadership basically believe we should be aiming and targeting at. So while 6x in 6 years looks good, interesting, what is the flip side of this in terms of these are the minimum guardrails of reaching EBITDA? What are the kind of businesses you would want to be in? What are the businesses you don't want to be in for reaching this number at a profitability which is meaningful for you as well as the shareholders? If you could just throw some light around that, that will help just close the 360 degree around this. Yeah.
Sure. If you see the last 8-10 quarters performance of the company, and I would like to stress on that, we have been extremely sharply focused on cost management, improving EBITDA, and coming back to our pre-COVID levels of 13% plus EBITDA margins. This is a journey we embarked on, and I think we have now demonstrated that fairly consistently over the last X number of quarters. Now, this is a benchmark that we have, and that is something we'll continue to work for. In terms of working capital, again, if you take last 7-8 quarters trend, or I would say even more than that, 10 quarters trend, we have been again prudent and working on optimizing our working capital, which again translates into a very high return on capital employed. These are all basic hygiene requirements that the board has mandated us, and this will therefore continue in our newer initiatives. Definitely, some of the newer initiatives will require investment in resources, technology, some amount of capex, but all these we have our internal guardrails well in place, and everything will be ensured to these are all accretive to the overall organizational vision.
So, any broader guidance on when do you plan to reach close to 13% or let's say more than double-digit EBITDA margins, basically going further?
So, if you see even my Q2 results, or if you take the trend, GCL plus Excel, our EBITDA margins are at 14.4%. Now, therefore, we are continuing to trend in a 13 to 15% range, which is what I would commit to, because there are, cyclicalities involved. There will be quarters where we will invest more.
Okay.
There will be quarters where the but overall, I think what we are working towards is a 13 to 15% EBITDA margin range.
Okay. All right. And just to follow up on this, like at the current EBITDA margins of minus 30% on mobility, if this is to be extrapolated, at what scale do you expect this business to break even? It's 175 CRO top line right now. Do we say, let's say 3x size from now, this business breaks even? Just asking a ballpark here.
Sure. See, Greaves Electric Mobility, it's a very different business. They operate on two segments, the electric two-wheeler and electric three-wheeler. Both of these have their own nuances. The mandate to the organization is to grow the revenues and there is a path to profitability. I would not be able to give a forward guidance exactly with dates and quarters in which we plan, but there are internal well-defined paths to profitability. I hope that answers the question.
Sure. For now, yes. Thank you.
Thank you. We'll take the next question from the line of Manoj Jetwa from KS Securities. Please go ahead.
Good morning, and thank you for the transformation journey which you have started some few years back. So my first question pertaining to Madam Makila, what are the genuine endeavors a company should think one has to do it rather than incubating new businesses or increasing the top line, which would really help in improving the margins and reducing the cost? Because I see the RMC cost stands around 69%, which seems to be very high right now. So what could be the focus endeavor of the company at this juncture right now, sir? This is my first question.
Can you repeat the question? I could not really understand.
Madam, my question is regarding what could be the genuine future endeavors or the present focus endeavor of the company in improving the EBITDA margin, PAT margin, vis-a-vis incubating the new businesses?
Sure. So going back, if you see our 10 quarters journey, we have been consistently improving our EBITDA margins. And post-COVID, I think we were almost at a negative margin. And from then, quarter on quarter, we have worked internally to ensure that the margin improvement journey continues. Around last quarter two, quarter three of last year onwards, we have been now consistently reaching the 13% plus EBITDA margin that we used to do pre-COVID levels. This is a endeavor of the organization, and this is what we remain committed to, an EBITDA margin of in the range of 13 to 15%. Coming to your question on RMC, if I were to look at the standalone RMC, again, we have been able to manage, and here I must also give credit to the soft commodity cycle currently going on, plus a lot of internal initiatives that we keep working on a very controlled and consistent improvement in our RMC percent. If I were to take H1 last year, our RMC percentage was 68.5%. Current year at H1, we are at 67.4%. So that is again a continuous journey that we keep on working, and hopefully all that translates into an improved EBITDA margin. I hope that answers your question, sir.
Yeah, thank you. Madam, my second question is pertaining to the Greaves Finance, Greaves Retail, and EV mobility business and new business. As you have onboarded Mr. Ramachandran to look after the EV business and mobility business, so are there any unlocking for the shareholders which could take place in 2 or 3 years down the line, where it could be listed as a separate entity in all the 3 segments?
So the new business head for EV and mobility business essentially is part of our overall retail strategy to grow the business. Any decisions on unlocking of value, capital raise, this is something that the board is cognizant of, and we will come back to you as and when the board gives a different decision.
Thank you, ma'am. A reminder to all the participants that you may please press star and 1 to ask questions. We'll take the next question from the line of Bhavesh Mehta, an individual investor. Please go ahead.
Yeah. Hello. Good morning. Ma'am, can you highlight what are we doing on the non-automotive business side? And like we mentioned in the Q1 presentation that we are doing something on the marine, industrial, and aerospace side. Can you highlight a little bit on that? What are our aspirations there? And also, what are we exactly doing in the Greaves technology business, and where do we aim to take that?
So maybe this is Arup Basu. Maybe I can answer a little bit on the non-automotive question that you have. So as you know, we make prime movers, and it's a fuel agnostic approach that we have. So the prime movers go for automotive applications in three-wheelers, etc., and also for non-automotive applications. So within that, while gensets is one product which uses engines, there are also other applications for marine in terms of boats, etc., that ply, and we're increasingly seeing an emphasis on river infrastructure and states with rivers and also coastal movements. So that's one area where where engines are used for prime moving. There's again a fuel agnostic approach there, and that the demand for that is in a way linked to infrastructure growth and overall underlying economic growth. So that's the work that's going on. We also are engine provider for fire pumps, which is a very specific specialty application because of the nature of the application of the fire pump. That's another sector that we historically have catered to, and that is also linked to the growth of infrastructure, because every high-rise that gets created or an office building that gets created requires these measures as part of the basic infrastructure. And those are the ones whose growth is linked to the overall industry growth. Thank you.
Yeah, and I hope I can just add to the gentleman's other question. So just to add to the non-auto, keep in mind, in addition to Dr. Basu talking about a lot of the OE applications, there is a non-auto aftermarket application which Mr. Narasimha and the GR team leverage, for example, in terms of several different customers, railways, telecom, etc. Right? So there are a lot of non-auto spares and service applications that the Greaves retail team addresses. So it was part of our diversification strategy when you look at our engine volumes going from auto to non-auto. Point number one. Point number two, very briefly, you also touched upon Greaves Technologies. That's a small incubated new business which really does engineering services to some global MNCs based primarily out of India, but serving both local and international markets. What it, of course, gives us is access to high-quality engineering talent, which does engineering services outside, but also helps in-house companies like electric mobility or our e-powertrain areas assimilate some of that technology and assimilate some of that integration. So it's a smaller startup right now. Thank you.
So where can we see Greaves Technology in next 3 years maybe?
So again, while we don't want to get into forward guidance, but the important thing is, from a competency curve, they started out with a mechanical, mechatronics, vehicle engineering type of services. So they do work for four-wheeler global auto majors, right? And then they're doing vehicle level work from engineering services. They've now gotten into software and embedded systems. So you can see some of the competency curve moving up the value chain, right? And you can also see them evolving more in terms of the electric mobility ecosystem, because they've been working closely with the Ampere team, right? And both internal and external. They're not captive. They obviously cater to both global and Indian consumers. Thank you.
Thank you, sir. We'll take the next question from the line of Kiran, an individual investor. Please go ahead.
Hi, thank you for the opportunity. Sir, two questions, two long-range questions. One on the EV side, Ampere. So if I look at our market share back in 21-22, it was about 12%. Now on a run rate basis Vahan data, it's about 3%, both two-wheeler and three-wheeler combined. So we are losing market share while the market is growing exponentially. So two-part question to this, right? One, are we continuing to focus on Tamil Nadu, because there's another Tamil Nadu-based player who has come up with excellent products in the two-wheeler space. So I'm just worried that we'll continue to bleed market share. That is one question, if you can address how are we kind of trying to regain market share. The second part question is, are we trying to do a IPO or a demerger of this EV mobility business, which will allow us to focus and get the right parameters in?
So I think I'll ask Vijay Kumar to come in and answer the first part. The second part, I think the CFO has addressed earlier on. The board has already said in terms of fundraise that they will be looking at a lot of options. That statement is out there. And as and when the board has an update to that, we will update you on the second part of the question. Mr. Vijay Kumar, please answer the first question, please.
Yes, thank you for the question. See, from a market share standpoint, first is that we are registering very robust growth month on month, quarter on quarter, primarily based on our new product. The Nexus, which we launched 2 quarters before, is doing very well. Our reference sales from our customers based on our service and spare parts availability, after-sales service is also doing very, very well. So now, to your specific question of Tamil Nadu and South, our footprint is grow not only in southern India. Our market shares are and at least double-digit numbers to what you mentioned in the eastern region, and we are building our market share and volume trends in north and western part of India. So we are a pan-India organization, and we will be able to see those results and responses as we go forward.
Got it, sir. Thank you for that. So then, from a company strategy perspective, it's very commendable, not just EV, right, the overall Greaves Cotton company. It's very commendable that we've got a 6x in 6 years kind of ambition, which works out about 15% CAGR, right? So 15% CAGR from. So what I'm struggling with a very, very ambitious target, which is fantastic, right? If I look at the last 10-year data, right, we were in March 2014, we were at 1,700 crore revenue. Right now, March 24, we closed at 2,600 crore revenue, right? So we've not even doubled in 10 years. So I'm just trying to figure out, is acquisitions a very, very large part of, like, is it the delta to 10,000 crores on acquisitions coming, or are there some business units you are extremely bullish on for the 6x in 6 years? I'm just trying to figure out what suddenly exploded in our industry that we can aspire to 6x in 6x while we have not even doubled in the last 10 years.
So I think Akila, the CFO answered that question right up front. I think she did mention that at the end of the day, it will be a combination of both organic and inorganic means, right? And opening up the multiple streams of revenue from a single cylinder, single industry diesel engine, which was catering to 300,000 vehicles a year, right? That was the sector Greaves Cotton was in, right? Today, you are playing in diesel plus CNG on the auto side, plus electric, so fuel agnostic. You're playing in auto plus non-auto on the engines and the component side. You're playing in multiple geographies. From the Excel, you've added construction, off-highway, marine segments, with a predominant version of that being high profitable global exports, right? So that's one vertical. The second vertical being in retail, and somebody asked this question, in terms of capital allocation, asset-light, high ROCE business, right? Franchisee-owned, franchisee-operated vehicles, franchisee stores, retail chains which offer spares, highly profitable spares, right? Again, there the diversification was going from a 3-wheeler diesel engine spares to 3-wheeler fuel agnostic plus 2-wheeler, plus now with Excel into other markets. So, plus moving towards the digital ecosystem, right? That's the second. The third is, of course, the electric mobility, which has a roadmap of its own, 2-wheeler and 3-wheeler. So I think when you just look at it organically, the multiple forms of revenue, the multiple applications, the multiple geographies, plus inorganic options is what the board is talking about.
Got it. Thank you so much.
Thank you. We'll take the next question. Before we take the next question, a reminder to all the participants that kindly limit your questions to only 2 per participant. Thank you. We'll take the next question from Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, Namaskar, sir, and thank you for the opportunity. Sir, if you could just explain the line item for other expenses for this quarter, what are the any one-off item that has gone into it?
Sure. Let me take this. Essentially, other expenses, all other expenses apart from RMC, this includes even employee cost, this includes consulting cost, traveling, all the rudimentary, everything, correct? I understand that your question is essentially it has gone up. As I said earlier, we are also focused on growing new businesses. So we've made investment in resources, in technology, and product development and business development. Now, some of these, therefore, will go into the line other businesses, and therefore, there is an increase over the past years compared to past years.
Because, ma'am, for employee benefit expenses, that has itself gone up by 10 crore quarter on quarter, and yeah, and 12 crore by year on year.
We have been investing in the resources. We've been investing in technology. We've been investing in business development, brand building to some extent, and all this is imperative to enable the future growth of the organization.
So when can we reap the benefit of the same, and especially for the category electric mobility and other vehicle segment, wherein we have losses closer to the tune of 100 crore for the first half? How should we look at in terms of H2 going ahead? And next question is on the cable and the control lever part. Herein, where are we in terms of the ecosystem for the this data center? If you could just give answer of these 2 points.
Sure. So if you look at Greaves Electric Mobility, like Mr. Vijay Kumar explained, we have had new launches both in e-two-wheelers and three-wheelers, and there is a good acceptance of that in the market. We have grown quarter on quarter 29% in two-wheelers and 30% in three-wheelers, and we have a very strong path to profitability. So while I would not be able to give forward guidance, I think some of our past performances can give confidence in our journey ahead. In terms of cable, push-pull cables, can you please repeat the question?
Yes, ma'am. It's regarding the data center ecosystem. Are we there as a player supplying to the data center ecosystem in terms of cable or any other functionality?
Sure. In terms of push-pull cables, I don't think data center is one of the industries we operate in, but maybe the genset business, which is where we operate in the data center business, that's an upcoming business, and yes, we are very much having our plans to enter that business also.
Yeah, Akhila, perhaps I can add. This is Nashima here from Greaves Retail. As Mr. Nagesh mentioned, we have a large non-institutional, non-auto business within Greaves Retail, and Greaves Retail is already working on solutions on the lines of energy management services, which cover the telecom and the data centers, data center segment. So essentially things like battery packs, the spare parts around that, the maintenance services, and so on. So obviously we won't be able to share more details on that, but I just want to let you know that we do play in that segment.
Thank you very much, sir. Ladies and gentlemen, with that we conclude our question and answer session. On behalf of Greaves Cotton Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.